Welcome back. Central banks around the world are adjusting interest rates in ways that could touch everything from your morning coffee to your monthly rent. Understanding this shift may help you interpret trends in the economy from an educational perspective. Stick around, because these changes might already be shaping your day-to-day finances in ways you don't see. This content is for informational and educational purposes only and should not be considered financial advice. Global economic policies are not abstract levers. They are the framework within which markets and households operate. Interest rate adjustments, for instance, are more than a tool to control inflation. They reshape the incentives for borrowing, investing, and holding cash. When central banks raise rates, it subtly shifts the balance between paper and physical assets, influences credit availability, and can create dislocations in risk pricing across sectors. Trade regulations operate on a similar principle. Tariffs, export controls, and sanctions do more than alter headline import costs. They change supply chain behavior, push premiums above spot for critical commodities, and can force market participants to hedge in unexpected ways. Fiscal stimulus and public spending, meanwhile, act as structural nudges, altering employment patterns, liquidity conditions, and even the perceived credibility of government balance sheets. In the past few months, these shifts have coincided with rising delivery risk in certain markets, selective decoupling between sectors, and adjustments in institutional positioning. For individuals and small businesses, the impact is indirect but tangible. The cost of credit, availability of essential goods, and long-term savings growth are all affected. Understanding these dynamics requires viewing policies not as isolated events, but as interacting forces that influence incentives, confidence, and trust across the financial system. Central banks around the world, most notably the Federal Reserve and the European Central Bank, have been navigating a period of unusually persistent inflation by adjusting policy rates. These moves are not isolated. They reflect an underlying effort to influence the cost of capital, liquidity conditions, and ultimately the incentives for spending versus saving. When rates rise, borrowing costs for consumers and businesses increase, which can slow credit growth and dampen leverage-driven expansion. This has direct implications for mortgages, corporate debt, and even the carrying costs of leverage positions in commodities and financial instruments. At the same time, higher rates can improve yields on certain savings instruments, but in practice, the realized benefit is often limited by institutional behavior, delayed pass-through, and structural constraints in banking systems. In markets where price discovery relies heavily on paper representations rather than physical holdings, interest rate changes can ripple unevenly, creating pockets of divergence between spot prices, premiums, and deliverable quantities. Over time, these divergences can signal shifts in market confidence, liquidity preference, and delivery risk, particularly in metals and other hard assets, where institutional positioning is sensitive to financing costs. Observing historical patterns, periods of rate normalization frequently coincide with a reassessment of risk, recalibration of leverage, and selective decoupling between sectors or asset classes. For everyday participants, the effects are subtle but cumulative. Borrowing costs, liquidity conditions, and the relative use of physical versus paper assets can change, illustrating how economic conditions evolve over time. In this context, interest rate policy is less about immediate gains or losses and more about structural trust in the financial system, shaping both market behavior and household financial decisions over extended periods. Inflation, when analyzed beyond the headline figures, is fundamentally a measure of how purchasing power erodes across the economy, and its effects are far from uniform. It manifests in groceries, energy, transportation, and a host of everyday expenditures, but the underlying dynamics are more structural than many media reports suggest. Rising costs often reflect shifts in supply chains, input scarcity, and importantly, the incentives embedded in financial and fiscal policies. Central bank actions, such as rate adjustments, are designed to modulate demand, yet they also influence the velocity of money, credit availability, and institutional behavior. In markets where paper contracts dominate, the apparent price of a commodity may diverge from its deliverable or physical equivalent, creating premiums above spot that are rarely explained in mainstream narratives. These spreads reflect not just market friction, but perceived delivery risk, liquidity preference, and hedging activity, all of which affect how inflation is experienced by households and businesses. Historically, periods of persistent inflation coincide with structural recalibrations, where consumers adjust spending patterns, institutions reprice risk, and long-term contracts are renegotiated to reflect new cost realities. This interplay is particularly evident in sectors with high exposure to energy or imported goods, where even moderate policy shifts can amplify cost transmission across the economy. For the individual, the short-term effect is visible in monthly bills and grocery prices. Over the long term, it alters expectations for wage growth, savings erosion, and the relative value of paper versus physical assets. Observing these patterns, one can see that inflation is not merely a cyclical phenomenon, but a reflection of systemic trust, incentives, and structural balance between policy measures and market responses. As policies attempt to moderate these pressures, the real question is not whether prices will rise or fall next month, but whether the frameworks governing credit, delivery, and institutional credibility can maintain stability over time, shaping the environment in which households preserve wealth and make financial decisions. Global trade and supply chains form the backbone of how goods move from producers to consumers, yet their mechanics are often misunderstood outside professional circles. Trade policies, tariffs, export controls, and international agreements operate as structural incentives, altering not only the cost of goods, but also the behavior of producers, distributors, and institutional buyers. When a tariff is imposed or lifted, it is not merely a line item on a balance sheet. It affects inventory strategies, hedging decisions, and the velocity of capital through various markets. Over the past months, subtle adjustments in supply chains, rerouted shipping lanes, port congestion, and selective sourcing have quietly influenced the effective cost of everyday products, from energy-intensive commodities to essential household items. These changes create divergences between spot prices, futures markets, and deliverable quantities, which in turn manifest as premiums above spot or localized scarcity. Observing historical patterns, periods of policy-driven supply chain disruption often correlate with increased delivery risk and temporary decoupling between paper and physical markets, highlighting areas where institutional positioning and risk management dominate market behavior. For households and small businesses, the impact is indirect but tangible. Prices at checkout, contract adjustments, and service fees can all reflect these structural pressures rather than immediate demand shifts. In markets like precious metals, these dynamics become even more pronounced. Paper contracts may trade freely, while physical delivery constraints create localized shortages, elevated premiums, and shifts in institutional behavior that reveal underlying system stress. Understanding these patterns requires viewing supply chain adjustments not as isolated disruptions, but as systemic responses to policy, incentive alignment, and market structure. Over time, these forces collectively shape trust in pricing mechanisms, confidence in deliverable assets, and the credibility of institutions managing the flow of goods, demonstrating that the most significant impacts of trade policy often operate beneath the surface, gradually influencing the real economy and household budgets in ways that standard reporting rarely captures. Government spending and fiscal stimulus operate as levers that extend far beyond immediate budgetary considerations. When a government injects capital through stimulus programs, it alters liquidity across the economy, shifting incentives for both households and institutions. Unlike monetary policy, which primarily targets credit conditions and interest rates, fiscal interventions directly influence employment patterns, sectoral investment, and the velocity of money. Cuts or reductions, conversely, tighten these flows, compelling markets and businesses to reassess leverage, risk, and operational priorities. Over time, these policy decisions shape not only the aggregate level of economic activity, but also the perceived credibility of public finances, affecting confidence in government obligations and long-term borrowing costs. In practice, this dynamic manifests in subtle but observable ways. Hiring trends may lag or accelerate depending on stimulus allocation, while the funding of public services can influence consumption patterns and local economic stability. For investors and institutions, the interaction between fiscal policy and financial markets is a key determinant of positioning, particularly in sectors sensitive to capital expenditure and credit availability. Price discovery in these environments can diverge between paper instruments and physical assets, as liquidity injections or withdrawals alter perceived delivery risk and premiums relative to spot. Historical analysis shows that sustained fiscal expansion, when combined with high leverage or pre-existing structural imbalances, often precedes periods of market decoupling, where institutional behavior becomes increasingly cautious, selective, and strategic. For households, the effects are indirect but persistent. Tax obligations, social services, and income growth trajectories all adjust to the underlying fiscal stance. In sectors such as commodities and precious metals, fiscal behavior can amplify or mitigate market stress, influencing both paper market positioning and the flow of deliverable inventories. Ultimately, the structural lesson is that fiscal decisions function as a signal of institutional reliability and systemic incentives, shaping confidence in the broader financial system over months and years rather than days or weeks. Understanding these linkages allows observers to contextualize short-term volatility within longer-term patterns of trust, leverage, and market structure. Currency valuations are often treated in the media as immediate reflections of economic health, but for a system-aware observer, they are better understood as the aggregate outcome of policy incentives, institutional positioning, and market structure. Exchange rates are not simply price points. They are the visible expression of how capital, credit, and trust interact across borders. Central bank interventions, interest rate differentials, trade balances, and fiscal credibility all converge to influence currency levels, creating ripples that extend into everyday economic decisions. And when a currency weakens, the cost of imports rises, influencing not only headline inflation, but also the structure of corporate supply chains, hedging strategies, and the pricing of deliverable versus paper markets. Conversely, a stronger currency may reduce import costs, but can also depress export competitiveness, triggering adjustments in corporate behavior and institutional flows. Historical patterns show that sustained currency dislocations often coincide with shifts in liquidity preferences, selective decoupling between domestic and international assets, and changes in premiums between spot and deliverable contracts and commodity markets. For the individual or household, the immediate impact may appear subtle. Higher grocery bills, slightly more expensive fuel, or the cost of imported goods. But over time, these changes accumulate, affecting real purchasing power, the cost of long-term contracts, and expectations for wage growth. In markets like precious metals, currency movements can have amplified effects. Paper contracts denominated in one currency may decouple from physical markets priced in another, creating elevated premiums and delivery risks that reflect both institutional behavior and structural imbalances rather than short-term speculation. These dynamics also influence cross-border investment decisions, as institutions reassess the relative attractiveness of assets denominated in stronger or weaker currencies, often leading to shifts in portfolio allocation, hedging strategies, and liquidity management. Understanding currency fluctuations in this framework allows for a more nuanced perspective on inflation transmission, import-export cost structures, and long-term wealth preservation, emphasizing that exchange rates are not merely reactive numbers, but signals of systemic trust, policy credibility, and incentive alignment. Over extended periods, these factors feed into broader confidence in the financial system, shaping how institutions and households allocate capital, manage risk, and position themselves in both domestic and international markets, highlighting that the most relevant effects of currency shifts are structural, cumulative, and often invisible in daily headlines. National debt and fiscal deficits are often discussed in abstract terms, yet for an informed observer, they are a window into structural incentives and the long-term credibility of financial systems. Debt levels are not merely headline numbers. They represent future claims on revenue, influence market expectations, and shape institutional behavior. When governments accumulate debt, they create obligations that interact with interest rate policy, currency valuation, and capital flows, effectively linking today's policy choices with tomorrow's constraints. Historical observation shows that periods of rising debt, especially when paired with persistent deficits, correlate with shifts in market confidence, risk pricing, and the willingness of institutions to hold long-term obligations without premium adjustments. These dynamics manifest across sectors. Social programs may face recalibration. Interest obligations can absorb fiscal bandwidth, and investment incentives adjust in anticipation of future policy responses. For households, the effects are indirect but tangible. Tax policy, public services, and borrowing costs are all influenced by the structural path of national debt, creating a subtle but persistent influence on purchasing power and financial planning. In markets like bonds, credit instruments, and even precious metals, these long-term considerations shape the pricing of risk, the divergence between paper and physical markets, and the willingness of participants to assume delivery obligations in uncertain policy environments. Elevated debt levels often coincide with tighter liquidity management, increased scrutiny of institutional leverage, and selective decoupling between perceived value and deliverable assets, as historical patterns show that financial participants recalibrate based on expectations of future fiscal pressure rather than current cash flows. Over time, these structural pressures feed into broader confidence in the system. If obligations are perceived as unsustainable or incentives misaligned, institutions may adjust positioning, premiums may widen, and delivery risk becomes a more salient factor. Observing these patterns, one can see that debt and deficits are less about immediate crises and more about long-term trust and credibility. They act as a framework that governs how capital moves, how risk is priced, and how households experience the real effects of policy decisions over years or decades. In this sense, understanding debt trajectories provides insight into systemic incentives, the resilience of financial markets, and the subtle mechanisms by which macroeconomic stability or instability ultimately affects everyday financial decisions. Financial markets function as real-time aggregators of information, incentives, and expectations, and their reactions to policy shifts often reveal more about structural behavior than immediate economic outcomes. Stock, bond, and commodity markets do not respond solely to headlines. They react to perceived credibility, incentive alignment, and the potential for future adjustments in liquidity, leverage, and institutional positioning. When a central bank raises rates, announces new fiscal measures, or trade policies shift, these signals propagate across markets unevenly. Equities may adjust based on projected corporate earnings under higher financing costs, bonds repriced to reflect altered interest obligations, and commodities realigned according to cost structures, supply chain expectations, and hedging activity. Observing these responses over time, one can see a recurring pattern. Markets often move in anticipation of policy effects, pricing and probabilities of delivery risk, divergence between paper and physical holdings, and institutional behavior rather than purely realized outcomes. For example, in precious metals, futures contracts may fluctuate in paper markets while physical premiums widen, reflecting selective decoupling, liquidity stress, and the credibility of delivery infrastructure. Similarly, bond markets may internalize the trajectory of national debt and fiscal obligations, influencing spreads and yields even before the underlying cash flows change materially. These movements are not random. They are expressions of incentives, structural confidence, and risk assessment across participants, from retail investors to large institutions. From a historical perspective, understanding these patterns can provide context for how systemic risk and market behavior have influenced long-term outcomes, without implying guidance for individual savings or investment decisions. Business investment decisions are equally affected. Access to capital, cost of financing, and hedging considerations are all recalibrated based on how markets interpret policy credibility and long-term incentives. Historical observation reinforces that periods of significant policy adjustment are often accompanied by temporary decoupling between asset classes, price distortions, between paper and deliverable markets, and heightened sensitivity to premiums versus spot pricing, particularly in commodities and hard assets. Recognizing these patterns allows informed participants to distinguish between noise and structural signals, assessing the probability of institutional responses, potential delivery constraints, and the evolution of trust within the system. Ultimately, market reactions are less about immediate gains or losses and more about revealing the underlying incentives that drive allocation, leverage, and confidence. By analyzing these behaviors, we can observe how systemic risk has accumulated historically, how institutional positioning has adjusted, and how trust has influenced different financial instruments over time. This perspective reframes volatility not as a source of panic, but as a lens for understanding the subtle cumulative effects of policy, structural alignment, and historical behavior on portfolios, capital flows, and the broader economic landscape. When examining the landscape of global economic policy, a critical pattern emerges. Individual policy shifts, whether monetary, fiscal, or regulatory, are rarely isolated in effect. A central bank rate adjustment, for example, does not merely influence borrowing costs in isolation. It interacts with fiscal policy, trade incentives, currency valuations, and debt sustainability to create layered and often compounding effects. This interconnectedness means that small-seeming decisions can propagate through markets in ways that influence inflation expectations, employment patterns, consumer behavior, and institutional positioning simultaneously. Historical observation demonstrates that these linkages are rarely linear. They operate through incentives and structural dynamics. A rise in interest rates intended to moderate inflation may simultaneously alter credit availability, elevate delivery risk in physical markets, and create divergences between paper and spot prices, revealing how trust in the system and confidence in deliverable assets are recalibrated. Similarly, fiscal stimulus or spending cuts ripple through consumption, corporate behavior, and capital flows, influencing market spreads, premiums, and institutional hedging strategies. For investors and households, the cumulative impact of these interdependencies is often more significant than any single headline change, and the periods in which market participants fail to recognize these linkages tend to coincide with the most disruptive repricing events, temporary decoupling between sectors, and elevated uncertainty in delivery and liquidity. Recognizing the structural relationships between policies allows for foresight. Rather than reacting to headline surprises, one can interpret shifts in rates, fiscal announcements, or trade adjustments as signals of how incentives are being realigned and where systemic risk may concentrate. In markets like precious metals, these linkages are particularly visible. Paper contracts may respond to policy signals in one direction, while physical markets adjust more slowly, producing widening premiums, selective scarcity, and concentrated delivery risk that reflects both institutional behavior and underlying structural pressures. Observing these divergences can help illustrate the credibility of supply chains, the behavior of market participants, and patterns seen in past market adjustments. The essential takeaway is that policies are not discrete events. They are interwoven influences that collectively shape market structure, institutional incentives, and household outcomes. By focusing on the systemic interplay rather than short-term noise, one gains a perspective that privileges analysis of cumulative credibility and trust over reactionary interpretation, highlighting where markets may adjust, where risk may be concentrated, and how strategic positioning can reflect the long-term alignment or misalignment of incentives. Understanding these linkages transforms policy observation from passive reception into active insight, allowing a more nuanced interpretation of inflation dynamics, employment trends, credit conditions, and market behavior, all within the broader framework of systemic trust and structural integrity. Global economic policies are complex, interconnected systems that shape markets, institutional behavior, and everyday financial decisions. Each adjustment, whether in interest rates, fiscal spending, trade regulations, or currency management, ripples through borrowing costs, pricing mechanisms, and delivery risk in both paper and physical markets. Observing these shifts through the lens of incentives and structural credibility, rather than headlines, allows for a clearer understanding of how inflation, debt, and market positioning evolve over time. Recognizing the cumulative and interdependent nature of these policies provides insight into where premiums may widen, where price discovery may diverge, and how institutional behavior can signal broader trust dynamics within the system. For households and investors, this perspective reframes uncertainty as a set of observable patterns, highlighting which decisions are shaped by structural forces versus short-term noise. By analyzing policies with an emphasis on incentives, historical behavior, and systemic credibility, one gains the foresight to navigate markets and personal finances with greater clarity and discipline. If this analysis has helped illuminate the connections between policy decisions and real-world financial implications, consider sharing your observations in the comments and exploring related analyses to deepen your understanding of these long-term systemic dynamics.